Welcome to PhillipCapital's Weekly Market Watch. The escalating debt load of many European nations has weighed heavily on the issues of sovereign risk recently. Historically, real local government debt is about 80% on average following a major financial crisis. Today, we have Mr. Liang Shiping, investment analyst from Equities, to tell us more. So Shiping, what is sovereign risk and is it on the rise?
Sovereign risk is the risk of default, a nation's inability to repay principal or interest on bank loans or bonds. I think there's a fine distinction between the ability to pay and willingness to pay. A country may have the ability to pay off its debt but chooses not to do so because of certain political decision. However, today the situation we are seeing is an issue of the country's ability to pay off its debt. What we have observed is that the trend of sovereign risk has been on the rise over the last quarter. The credit default swap market, known as CDS, showed a 93% of the sovereign credit widened by 30% on average. Spreads in France, Portugal, and Spain are more than doubled, while grids soared from 346 basis points to 1,003 basis points, at one point becoming the riskiest sovereign in the world. Therefore, bond investors should really pay extra attention investing in vehicles which are exposed to countries with a significantly higher risk of sovereign default.
What impact do you think the euro sovereign risk has on the euro at this moment?
I think the long-term outlook on the euro is still bearish at the moment. Taking on new debt to pay for social services and paying off old debts is not a long-term solution. I would say that sentiment towards the Eurozone and the Euro has not been this negative since the inception of the Euro. Over the last 2 years period, Euro-dollar had a roller coaster ride, falling from a high of 1.6 to the recent 1.19 mark we saw a few weeks back. Since its November high back last year, it has declined more than 20%, making it one of the worst performing major currency year to date. There are three levels which the market is currently watching very closely at the moment. Firstly is the euro launch price back in 1999 stands at the 1.18 mark. Following that, the 1.0 parity mark, which is still another 20% away from the current level. Also is its historical low at the 0.82, a possible level in the worst case scenario.
What about some of the lowest default risk nations at this moment?
I think if investors are looking for nations with the lowest default risk, they can look to countries such as Norway, Hong Kong, and even Australia. Take Australia as an example. Australia has a very low sovereign debt level, which is about 13% net. It is rated AAA by S&P, and its major political parties are committed to a return to surplus by 2013, backed by the growing exports of basic materials to the most rapidly growing large economies like China in the world. And if you look at its country's monetary policy, the RBA had achieved credibility since its inflation targeting measures back in 1993. So from a fundamental point of view, Australia stands out against the heavily in-debt European countries which are suffering from a weak economic recovery since the recession.
Is this the right time to invest in Australian equities?
The Australian stock market went through a correction phase recently, partly due to the global economic worries and the new proposed tax by the government. I think that the market has reacted positively since the new mining tax agreement between the Australian government and mining companies was announced at the start of the month. Valuations are looking decent with a price-to-book ratio under 1.8. Unit trusts are good investment tools to gain exposure to Australian equities.
Thank you, Shiping. That's all we have for you today. Tune in next week for more market updates.